Morning. Ready to go? Oh, yeah. All right, let me start by popping a poll. What are you trading today? See what's going on. Thank you, Ashish. Yes, it is Kenyatta Day. Welcome, welcome. Sam, you can buy my Hong Kong company. I was thinking about selling it. I think it's almost 20 years old. All right, I guess we'll get going here. All right, good morning, everybody. Happy Canada Day. Happy first day of the second half of 2024. It's a key turning point in the year. Oh, for sure. So let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, never risk money you cannot afford to lose. Hello, my name is Wayne. I'm a currency trader just like you. Today we're going to do technical and fundamental analysis. Yeah, there's lots to cover. It's an important week. We have a holiday today in Canada Day, but then on Thursday we have 4th of July. And the markets are closed, and the Bank of Japan is going to intervene. Well, nobody knows that yet, but anyways. Yeah. Friday, we have non-farm payrolls. Wednesday is a massive trading day this week. And then when we get back from the weekend, so a week or so from now, we start earnings season. Yeah. So, look, the next 10, 15 trading days, or 10 or 15 days, going to be critical to the open of the new week. Yeah, pretty amazing stuff. Please fill out the form. I'm going to give you a value ladder here. Okay, you need a good broker. Most brokers trade against you. ECNs do not. They have a complete different technology called straight-through processing. So you want an ECN. There are a few out there, not many. Like I said, most brokers laugh at you when you lose money because they keep your money by trading against you. But I recommend Trader's Way. You should check them out. If you need to learn how to trade, $88 at Investor Bootcamp gets you 88 hours of training. And not just babble videos, but like lectures. Some of them are ridiculous, meaning just one of, the 20 courses, just one of them is easily worth 1,000. And if you really wanted to debate, you're like, oh, it's only worth 500. Okay. Just one of those courses is worth 500. All of them together are 88. So anyways, go there. Then once you've learned how to trade, you need to add fundamentals. Go to QuantBox. You're going to need QuantBox. It's really extraordinary. I guess I should show you the updates that we've done recently. So in the couple of years of QuantBox, we've constantly upgraded it and never have risen the price. Okay, so there's a couple of things I can show you, but I guess the most important one is this, where we now look at the options trading market on 3 time frames. VIX, long-term treasuries, short-term treasuries, gold, dollar, yen, and the stock market, all on 3 time frames. Correlate them into risk on or risk off so that you can observe the intrinsic underlying trend. You can't observe it directly, you can only observe it indirectly. And we've had dude, this is killer. Okay. By now you should have already updated and yourself on the commitment of traders report and the changes bullish and bearish. You should have already have done that. Okay. If you're not reviewing information like that, you're an amateur. Just that simple. And then TRADARS automates your technical analysis. A lot of people have sent me emails, like a lot of people love it. I just love the idea. A lot of people are hesitant. And they're like, well, I don't really trade patterns. Dude, it's pointing to the direction of the trend on multiple time frames. You don't have to get hung up on whether you like patterns or not. This helps you focus on the things you should focus on. It's a time saver. Okay. So it's not just like pattern recognition. It's not all A, B, C equals D. No. It's showing you that you should be buying dips. You should be buying dips, or that we're coming up to vulnerabilities. Like, don't get hung up whether you like trading patterns. It's so much more and so much simpler than that. Yeah. Cool. So that's the value ladder. Today, the market open. We have ISM manufacturing this afternoon. We've had our inflation data. We have Apple potentially breaking down today. Meta potentially breaking down today. USD CAD potentially breaking up today. USD Swiss franc already trending up. S&P 500 potentially, okay, lower low, lower high, creating a new lower low. FTSE may be a breakout recovery, but not necessarily. All right, not necessarily. Oil potentially coming down on the 30-minute chart back to 81.5 to 81. Gold, maybe. What do you think? The beginning of an inverse head and shoulders? Maybe, but it's gone nowhere. Okay, but these are the things forming. Do you want to look at gold today? See, it puts your focus on the right thing. Okay? Many of y'all, not all y'all, but many of y'all are just going to trade the same thing that you trade every day for no particular reason at all, except it's habitual. And that will never, ever, ever lead you to success. So if you have an edge because you have spotted a technical formation on an asset class, then maybe it gets you looking at the right thing. Now, I'm not a big fan of trading gold, but okay. But maybe you are, because now you can look at it and do your analysis. And do you like trading it? And I'm like, no, not really. No, not really. So, you can have it. But that was a pattern it did see. Cool. All right. Take a look. Bitcoin's still rangy. Bottom of the range. M2 gets you to M4, which is actually the top of the range. So that's plausible. Silver, on this time frame, you can see it's trying to get above the moving averages. Okay, 21 is above the 55, and they're diverging, which is bullish. So it gives you permission to look for a little skippity scalp off of that. S&P 500 on the daily has double topped. You can see it a little bit better there. So it will matter. We're in the buy zone, okay, on the daily. Sorry, that's weekly. We're in the weekly buy zone. And so if it fails, it's important. It's definitely important. Yeah, it's meaningful. Very meaningful if we have a down week. Okay, oil trying to climb back up. That's kind of interesting, huh? It took me out on this drop on Friday. But here we are, just inching our way up. We dropped to 81.5, and then we got to 82. Now we're using 82 as support, maybe. We're at 82.30. It's kind of interesting, staying above 82. And there's our little, 15-minute. So what we're trying to look at is the importance of the top and the importance of the bottom. And so if you were a bull, and I'll go look at the poll, but and see how you answered, but it could be one of these things. Huh? Could be. I don't know. It's just one possibility. What do you think? Stock market opens in about 10 minutes. What do you think of this? David's not sure. He's being wishy-washy. Maybe could be. Yeah, I like that. Agree 100%. Yep. Cool. Yeah. I don't know. I don't feel good about this one, Sarge. You gotta go sometime, Barnes. Mm-hmm. Yeah, Steve. It was such a good movie. And then Tom Cruise was supposed to do Wall Street and then dropped out to do Top Gun. So then he put what's his face in Wall Street, and that was also a great movie. Yeah, David, I spoke about that today in QuantBox, in the QuantBox video, and Le Pen didn't get as much as thought. I think it was still 33%, but not as much. It wasn't. So, this idea that going from a far left to a far right means everything has to change. And that makes things, as far as trading and investing, difficult because, because we're talking about trade, we're talking about taxation, we're talking about fiscal policy. So everything's going to change, but what way and by how much? And that it makes long-term investing, like from a business point of view, a very difficult thing. So in this case, Le Pen didn't have like a runaway majority, didn't get like 50%. So in this case, there's sort of like now there's more likely to be more of a moderate change, which is a little more digestible, if you will. So radical changes are not likely to go through if or when Le Pen's party, um, is able to build up political power. So it's sort of like a moderate change versus a radical change, and so there's a bit of a relief going on right now, but I don't know how long that's likely to last. Yeah. But it looked like Le Pen was going, and the right wing party was likely to get a very significant, amount of political power, and that's what brought euro down. Because again, the radical change is very difficult for investing. Ultimately, I go back to what I said at the beginning of the whole process: is that we end up with a stalemate. Okay, I and that's not likely to be good for euro. But what I've also learned over the years is at the end of the day, it doesn't matter. The euro is impacted by Fed policy. And if the US dollar is going to weaken, euro is going to go up. And it doesn't really matter what's going on in Europe. But we'll get there in a little bit. Yeah. So, anyways, that's the nonsense of what's going on today. Is but on the longer run, yeah, we got bigger challenges, in my humble opinion. But there's always the day to day, right? All right, we'll let that do its thing. I'm also interested today in the stock market open, which is in just a few minutes. Kind of interested in what's going on here on the NASI. So above us right here is the projected high for the year that I did in January. How cool is that, huh? Yeah. So, I don't know. It's not that I want the stock market to go down because I do have a lot of exposure, long exposure to the stock market, but this is fairly seasonal. Yeah. So I have reduced my exposure as far as the idea the stock market can come down for a while. I mean, months. That could be the top. Okay. If not the top of the year, we'll revisit this level probably like December. So still fairly, so that means we could have 2 or 3 months down. And if that does happen, I don't really want to short the stock market, although I have here. I can reduce my exposure. So remember, as someone that manages endowments, I'm not a stock picker, I'm an allocator. Right? With big teeth. An allocator. An allocator. So it's more like, how do I readjust the portfolio to reduce my risk? That's all. And so the two things that are likely to happen between now and the end of the year, I think we could have downward momentum in the stock market for a few months. But also between now and the end of the year, the Fed cuts, right? We can debate if it's 1 or 2. But most people agree by the end of the year, they're going to cut. So I can also build up positions with that in mind. Because, as Forex traders, you might be watching everything on the 15-minute chart. And there's nothing wrong with that. But with this, as an allocator, I can redesign or rebalance the portfolio with this in mind, even though it could be 6 months from now. There's quite a difference, isn't there? By the way, I designed the model. I designed the portfolio to provide retired people with an income. You have to understand, like, when I designed it from the very beginning, I read a story about a 92-year-old woman. Even her kids have died of old age. She's 92 and her kids died when they were like 70. So anyway, so she was still alive and she lived too long. She ran out of money. And for some reason that it really frightened me. I don't know why. I don't know this person. But it frightened me. I'm like, oh my God, what happens now, right? Like, ugh. And so I constructed this portfolio to do two things. One, provide retired people with enough income to live on. And the second thing is the money never goes away. You never actually spend the principal. So like if, this woman had retired in her 60s, when she's 92, all that money is still there. I wanted to design something where you never run out of money. And a traditional retirement portfolio means you sell what you own, you sell assets, and you live on that. And you dwindle it down, but if you live too long, you just run out of money. And I'm like, well, that's not the right way to do it. So when you die, you should have all your life savings still there to give to either your children, your grandchildren, or to charity. Okay? So anyway, I ran the model. The portfolio's 8 months old now, so it's not a year old yet. So, but anyways, I ran the model and I said, okay, if a retired person gave me $1 million back in October with this portfolio, what would have happened? And that person, and this is gross, by the way. This is assuming I didn't charge any fees. Oh, I'm going to charge fees, but this is gross, okay? But nonetheless, in those 8 months, that person has received $92,000 in cash to live on. On the flip side, though, well, what about the principal? What about the $1 million? What's in the account now? $1,062,000. So there's $60,000 more in principal, and the person has received $92,000 in cash to live on over 8 months. A little, basically 10 grand a month every month. With half the volatility of the S&P 500. I am so happy. My dream has come true. That's exactly what I hope to do. I couldn't be more pleased. That's very, 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 very hopeful. Pretty cool, huh? Yeah, I was very, very happy with that. Very, very happy with that. And the whole point of it is that there's no guesswork. There's no, I picked the right pony. There's none of that. There's no, oh, well, he just happened to pick NVIDIA and it's up. No. The whole thing is designed. There's no luck. It's the whole point is to get rid of good luck or bad luck. There's no luck. It's all manufactured by design. And that makes me very, 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 very excited. Yeah, I saw that. So the idea is there could have been profit taking at the end of the first half, and now you redeploy back in. Okay. It may not be the right thing to be doing, but very often is what people do. Okay, so you took some profit, and the reason you book profit is it goes into like a quarterly report that you send to clients, and you're like, we made all this cash. But if you're sitting on cash, clients could ask you for the money back. And they want to say, no, well, we reinvested it all, so we don't have any cash. So they want it on the report, so they take profit on certain things. And there's also tax consequences, right? So you can take some profit on your best trades and cash out of some of your worst trades and offset each other, right? Tax-wise. And leave the majority of everything together. And then with whatever cash you have left after that taxable event, you redeploy back in on the new quarter. Okay? It's sort of a tax wash, if you will. Okay. Here's what I've been doing. I've been, okay, here we are. I've been preparing for this. So we're talking about S&P 500. And I've been preparing for the plausibility of this. So in January, we talked about this being the peak, and that this September-October low is going to shift to here. So even though we have the 20-year and the 5-year, okay, I think it's this year is going to look like this. I covered this in January. Okay. So I've prepared for it to happen. Okay, you see how amazing QuantBox is? Okay. Okay. We are here. So, but from this week to next week to the week after. So in the next 3 or 4 weeks, we usually top out. So we're in week 27. This is week 28. And on average, okay, week 28 is 2 standard deviations above the mean, which means sell down to week 39. Shut the back door. Yeah, you didn't know that? I mean, my God, right? You're like, wait, what? Yeah. So we're in the slot. We're in the window, y'all. This is change of direction time, and I've already prepared for it. So this is sort of your last chance. Now, I don't know the future, but I do know the past. Okay? Oh my God, don't you, right? And so now, maybe the meaning of a double top. Okay? Because now you know, like, historically, okay, I mean, just imagine that this week is sort of a modest up week and we triple top next week. Okay? Imagine that. I'm not saying it will happen, just imagine it happened. Okay? Over a long period of time, we found out that this triple top would also be 2 standard deviations above the mean as far as a move, and then it drops from week 28 to week 39. So 10 weeks down minimum. The thing is, if you don't know, then you don't know what kind of weight to put onto that scenario, right? But I said in January, not only will it drop 10 weeks, it'll drop longer than 10 weeks. Probably closer to 15 weeks. Well, then that gets interesting, doesn't it? Okay. Gets interesting. So Chewy.com is up 20% today. Okay, we got the ends on the move. Yeah, the ends are on the move. Almost 100 pips each. Prime for some deleveraging, yeah. Well, it's seasonal too. Yeah. I have an interesting stat for you guys. So I ran the numbers on this coaching account for last month. Sorry. My coaching account, right? So you go custom period because it tries to throw the wrong month like July. So you have to manually go to June. So June 1st to June 30th. Okay. And then you run the save as detailed report. Save it. Yeah, create a new one. Opens up over here. First of all, so $327 plus 461 floating. So combined 700, almost $800, right? So I got my 2% goal. Okay, 2% per month is my goal. So I achieved that. But I want to show you something you might find interesting, and it has to do with risk management. Where does it show it? 81% of my trades were losses. My average loss was 19 pips. My average win was 191. 10x. My winners are 10 times my losers. And I'm in some of my winners still. What do you think? Any comments on risk management? Any thoughts? Any comments? Do you love it? Do you hate it? Is it good? Is it bad? What's your key takeaway? Still got 800 pips. 800 pips with 81% losses. And that's after accounting for the losers. That's after subtracting the losers. And remember last month, I had to kill all my trades because I was making too much money. And the rationale that I tried to share with you was just trading the way I teach you. What happened was I put down more trades. I said, I want you to try to trade more. So I put down more example trades. Not nearly the same amount you should be doing as a regular trader, but more than my normal coaching, which is, that, what did I do? 25 trades last month as examples. So that one I did more like 25 in a week or so. But I was up something like 10 or 12% in that week. So what does that tell you? Even this coaching account, $37,000, I'm trading mini lots. I'm over leveraged. These prop funds that ask you to make 10% a month, that's ridiculous. Unfortunately, that's how it is. But when you go to Barclays Hedge, let me see. I haven't been to their website in years. Barclays Hedge. Let's see if I can find it. Funny. I misspelled it so bad it didn't come up. Okay, Barclays Hedge. There we go. So Barclays Hedge is the leader in CTA analysis. They look at licensed and registered investors that run like managed futures programs, which is what we do. That you can call it like a Forex hedge fund would be included in here. Because it's not technically a hedge fund, it's technically a managed futures program. All right. So anyways, they analyze thousands of CTAs, commodity trading advisors, and tracks their performance. So you, as an investor, you can compare. And they have all the different numbers and stuff like that. Okay. At any given time, there's 2 or 3 CTAs in the Forex business that are just crushing it. Now, it doesn't mean they're crushing it for years. They may have a few good months in a row, for example. Okay? Okay. Those best of the best currently, the ones that just happen to be hitting the trend just right, they're making 2% a month. Like I show you, like my 2% this month. That makes me, I don't know, now this coaching account, I don't have like $1 billion or anything, so it's not fair to compare. But nonetheless, I'm performing as well as the best of the best. So to ask an amateur to produce 10% a month consistently is just stupid. It means you're like extraordinarily over leveraged. And it just shows you, like, again, last month, making 10% in a week. 10% in a month is stupid. And to do it in a week or 10 days or something, I didn't want that to become, because that's the cliche on YouTube, right? Some kid, he's got an account, and he made, $5,000 today, and he's like, oh, now I'm going to go get my Lambo. And you're like, ugh, makes me vomit. So this idea, like, that's what you should be doing. No, that's not what you should be doing. I want you to create a sustainable business. So if the best of the best professional traders are doing 2, and really good traders are doing like 1.5, but they're doing it month after month after month, that's the secret to success that you're looking for. And so last month I had to stop. I'm like, whoa, I should probably be trading 1 or 2 micro lots, not mini lots, right? So here's now a second month in a row of just showing you sort of better forms of trading. And, even with with proper risk management, you can have mediocre performance and still hit your monthly goal if the math behind your strategy works. Now, if you do not have the ability to set up a good trade and hold it, then you will never make it. Okay? You'll die on the vine. You'll never quite make it. Success will just be slightly out of reach at best case scenario. You have to learn how to make better setups, meaning combining technical and fundamental analysis, pivot points and seasonality. Like all these fairly complicated things go in, but then you know when to hold them. You get a half decent trade and you hold it for a couple of weeks, and therefore, everything that busts out are tiny little losses like I just showed you. And the things that work, and you're like, yeah, it's okay. So I hope I'm being a good coach and showing you the right way of looking at how to trade professionally. You have the tools, but you still have to have the knowledge and the attitude and all that kind of stuff. And so, yeah. So anyways, you'll find this data in Barclays Hedge and CTA rankings, first quarter 2023. That's old. Maybe they'll allow us to look at the old one. No. So I used to have an account. Yeah. Okay. But if you're an allocator, you would have that account, and when a Forex person comes and says, you should invest with me, well, you can compare that person's results with, hundreds of other Forex traders. And you're like, well, your Sharp's not that great. Your Sortino is off. I've looked at your actual numbers, and, the inconsistency bothers me, and, all that kind of stuff. Okay. Do you understand 2% a month compounding is more than 24%? It's like 27, 28, closer to 30. Dude, 30% a year is very good. Okay. If you do 30% a year and you use leverage to do it, you will have a poor Sharpe ratio and you won't be fooling anybody. So a young gun trader that comes up to a seasoned investor and says, I did 80% last year, is not going to get money. And that seasoned investor will just say, well, show me your Sharpe. Your Sharpe ratio is risk-adjusted performance. So you're up 80%, but you probably got a low Sharpe because the vol would be too high. And so it'll say, okay, you made 80%, but you took more risk than you got reward. So next year, if you get unlucky, you'll have a down year that's significantly bad. And therefore, the seasoned investor says to the young gun, I'm super happy for you. I'm happy for your success. 80% is amazing. But right now, Forex is not a good fit for my family office. So we'll take a pass, but we wish you the best of luck. And what they just told you is you're full of shit and they're not going to invest. Yeah, cool. Now, what about the person that's doing 2% consistently per month, but they're doing, let's say, 100 trades a month? Okay, like think of the volatility that I produced. It doesn't. MT4 doesn't provide Sharpe. It's really too bad. But my average loss was 19 pips. And my average win was 190. What do you think my Sharpe ratio is? if my losses are tiny, what kind of volatility does the portfolio face with tiny little losses? Do you think there's high volatility or low volatility? Yeah. And then when you wash out all the winners minus all the losers, there's 800 pips over low volatility. It's insanely good. And you show that to an investor, you're like, I made 800 pips. I took a lot of losses along the way, but they were tiny, so there's low vol, but I produced the 2%. And they look at the Sharpe ratio, it's going to be high, and they're like, we're very interested. So I need to I'm trying to teach you the numbers here. Okay, this isn't about me. This is about how to work the numbers and what a professional investor wants to look in or look for when allocating capital to a professional trader like you. There's the investor and there's the trader. There's the allocator and the manager. Okay? And so the manager needs to know what the criterion of the investor, right? And we call that risk-adjusted performance. And that's what you're trying to get to. Okay? Yeah. Yeah. Cool. So these yens are running. I have one at 116.5. We're above 100 pips on that one. Where's the other one? I don't remember what it's on. Is it this one? I don't remember. Which one is it on? Aussie yen, CAD yen. CAD yen, Aussie yen. I don't even see it. Oh, it's way down there. This one at 116, or sorry, 106. We're at 107.66. Doesn't pay very much, but that's 160 pips. And this is 125 pips. Okay. Let it run, huh? The question here, what's the ideal risk per trade, right? I like to think of it as a monthly. I think monthly and quarterly. And when you're thinking about risk, it should be monthly. Oh, here's the news, huh? It's only manufacturing though, right? You want to think about risk monthly and you want to think about opportunity quarterly. Okay. And so what you want to do is look at how many trades you make per month. And it should be like 100. And if you just fell out of your seat, you're not trading properly. If you're like, well, I only make one a day, you make 20. 20, that's it. 20. Well, if you have a couple of bad trades, you just, bad luck has just ruined your month. You have to trade more than that. That's why you want smaller lot sizes. So let's say you make 100. Okay. Then you want to figure out, okay, in your worst month ever, which you will have to report for 5 years on your track record. So think of it. For 5 years, you'll have to show investors your worst month. The question is, what do you want your worst month to be? 2%? 5%? 10%? If you show a minus 20 on that track record, you're out. You're out of the business. You will probably get redemptions and your current customers and clients will leave, but you will never raise new money. You're dead. Now, almost everybody here probably has a negative 20 in the last 5 years for a month. You cannot survive with a negative 20. Yeah, and the question is, even minus 10 is out. You'd have to, the way to survive that, and, you know, I'm assuming you have some, let's say, qualified investors, some fairly sophisticated, experienced investors. If you just have, you know, your mom's chiropractor, I always like that one, your mother's masseuse, yeah. Okay, so they might be okay with it because they don't know any better. Okay, but a more sophisticated investor is going to look at the beta first and say, well, the beta, and we'll call it a benchmark. So let's say the S&P 500 dropped 10% that month, and you dropped 10% that month. You could probably survive because there's a relative comparison. And institutional investors do this. They know what months to look for. They don't just look at your performance. Oh, you made 80%. Nobody cares about that. So they'll know, like April of 2024, the stock market dropped 6%. So if you drop 4%, you're okay. If you drop 6%, you're okay. If you drop 10%, they're like, okay, you dropped more. You have a higher beta than the S&P 500. We'll probably do some due diligence to try to figure out why. Why did you lose 10 when the broad market lost 6? But at least there's some sort of comparison. But a negative 20 is like death. Right? Dead on arrival. You're toxic. And not the cool toxic like Britney Spears in a miniskirt in a private jet. Wow, 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 wow. Right? No. Yeah, no, you're out, my friend. You did nothing to mitigate risk. So there might be a way out of a negative 10 if the broad market did it. Now, if you just lost 10 and it was just sort of random and you're not correlated with anything, and it's not even that you're not correlated, it was just like you're just random, you're out. You're sloppy, right? Right? You're just a sloppy, your trading is ugly. Yeah. Now, again, if you learn right, you know, the track record I just showed you for June, tiny little losses and then big winners. People are going to look at that and go, "Oh God, that's wonderful." Yeah, I mean, that's what they're looking for. So I would reckon, okay, I would reckon your worst month should not be more than -5. So for those out there that are getting 20% in a month, but and then later in the year you get a -20, it's not what people are looking for. So when you at the end of the year, people want to know how much money you made for them. Now, if it's mathematically random, who knows? It could be up 20%, it could be down 20%. It's a coin toss. That is not what people are looking for. Okay? That's what people want to know. Do they invest into you or another manager? Do they invest into you or into an apartment building? See, like an apartment building or buying a bond portfolio, there's reliable income and then some variable of the value of the asset, but it's not likely to go to zero quickly, right? And so they're comparing you and they're like, okay, if they invest into you, you'll either make a lot of money or lose a lot of money. And, well, 3 bad months in a row bust out your fund. But, you might make 20% in February, but lose 20% in March. On average, nothing happened, but the vol is crazy. And all of a sudden, like, people just don't know. It's not attractive. They're like, I don't know what this is. I might make a lot of money, but I might lose a lot of money. You're like, that there's so many better opportunities for money. Nobody wants that. So you should engineer the way you trade to get favorable results. Do you understand? But this idea of 1% a trade. So what, in 5 trades, you've ruined your month? I would argue that that's way too much risk. Okay? Extraordinarily too much risk. Okay? Okay? But in the beginning, when you ain't got no money, if you have a small account, that's how to grow it. I would rather you focus on building a beautiful track record that everybody's looking for and then go raise money and trade opium. Do you want to be an opium trader? Other people's money? OPM? Yeah, and now you're a professional. You make a little management fee, you keep some of the profits. Okay? But you trade your own account. So, okay, here's the thing. You have your account. And then you have your fund. And your account's small, but the fund is bigger. Okay? But you connect these two. So you're trading the fund, but the fund is just following you and you're trading your account. So here you get a 2% management fee plus 20% of the profits. And you live on that. Food. Rent. Okay? But this, okay, the profits go back into your account. Now, fast forward 20 years. Your fund looks like this. Because you're compounding it, 100% of your profits are reinvested growing your account. And your account becomes bigger than the customer's accounts. And now we call that FU money. Okay, this is the internal fund. This is how hedge funds work, by the way. Even the traders, the managers of the fund, okay, want money into this fund. So they'll put in, so like, for example, as a VC, the normal thing, okay, you want to, I hear a lot of college kids too, especially when I was at Harvard, they want to be a hedge fund. They want to work in a venture fund, venture capital. Now, a tiny, minuscule venture capital firm has 100 million. But that's so small, it's kind of the joke in the room, the peon in the room. But it'll help with the math. Okay, so you have general partners. Oops, let's do that in black. You have general partners, and then you have limited partners. General partners run the fund. The limited partners invest into the fund. But there are certain things that the limited partners want from the general partners to make sure that their money is invested safely. A standard operating procedure in the VC world where I come from, that in a $100 million fund, each general partner, so you want to be the general partner. It's your hedge fund or your venture fund, okay? You would have to invest of your own personal money, okay? 1 million or 1%. Standard operating procedure. Oh God, Jake. Oh, you don't have $1 million? Then why do you think you're qualified to invest 100 million or $1 billion? Right? Like, you're supposed to be able to pick good startups and help them turn into successful businesses? Yes. Well, put in $1 million. I ain't got no money. Then what the hell? Then where did you get your expertise, right? Like, why are you so good if you don't have any money? And so you kind of get into the same thing in the FX world. But in the beginning, you're able to run, like, you got your small fund, but you have a good track record. Okay? So you can then build your outside fund, but you keep, and everything's run off your internal fund. Okay? And you'll never get filthy, stinking rich trading client money. You will provide an honorable service to people. And they will compensate you for your time. But it'll never be big. But it should be enough. But you're like, but well, what about the big houses and fast cars and exotic trips? It's from providing an honorable service to your clients for 25 years. And what you do is you never spend your internal money. The internal fund grows and it becomes many millions of dollars when you retire. Okay? Because you've compounded it, keeping 100% of your profits in there year over year over year for 25 years. And remember, if you're making 10% a year, okay, you only need about 7 years to double your money. So if you're making 20%, your 2% is almost 30. Then, dude, every like 3.5 years, you're doubling your money and doubling your money and doubling your money and doubling your money and doubling your money. And your internal fund goes massive, even if you only begin with 10K. Okay? 10K becomes 20, becomes 40, becomes 80, 160, 320, 640, and it grows. investorbootcamp.com. So but the thing is, you got to have that long-term game. If you're really going to do this, okay, you can't reek of poverty. Okay, the YouTuber kids, they're showing you how quick they're making their money. Oh, I moved 20 pips and I made $2,000. It reeks of poverty. It frightens rich people. It's so funny. Yeah, you'd never be able to create a small business that's sustainable. And how do you create a small business that is sustainable? You create more value for your clients than you charge. You make the world a better place. It's about value creation. And you do that over long periods of time. You'll have loyalty and respect from your clients. And you'll grow your internal fund. And you'll live a happy life. But that's what I want to teach you. Okay? That's what I want to teach you. How to run a sustainable small business that creates value for people. And from that, you can build your net worth. Okay? So I hope you share the same vision. Leave a comment. Let me know what you think. Do you agree or do you disagree? Peace on earth. May the pips be with you. May your profits be above average.